that everybody promised us a bear market if those names struggled. That's not happening. The money is sloshing around, going to other areas. That's a healthy sign in our opinion.
So do you think we have another strong second half of the year, this 2024?
Maybe we up that target, but the money and the models that we run for our Carlson partners, we remain overweight equities. But we've honestly thought there's more opportunity in small and mid caps. Mid caps are probably our largest overweight bet that we're making. Mid caps quietly are doing well. I wouldn't be surprised at all if we looked up at the end of the year, mid caps and small caps might have gained almost 20%.
Antes de ver el vídeo al completo, recuerda darle a like, suscríbete a mi canal si te gusta este contenido y déjame tu comentario, que lo estoy esperando. Bueno, pues una vez aquí con nosotros, Ryan Detrick, ya sabéis, analista de Wall Street, muy conocido en redes sociales, con unos análisis fantásticos, unas estadísticas geniales, y es un placer tenerle por aquí. Thank you very much, Ryan, for being once again on my channel, and it is a pleasure to have an analyst of your ability.
Well, I'm honored to be back. There's plenty of things to talk about, so I'm ready to roll. Thank you for having me.
Thank you again. And first of all, as you said, this is a moment we have a lot of things to discuss. One of them is last year you comment here on my channel that there was a more potential for good economic growth in the United States, and there was. So you also comment that in your 2024 you had good projections. The timing of the economy remains positive right now if we look the numbers. So do you think the economy and the stock market are still clear for this year?
We do. So again, when I joined you last year, there was a lot of people who doubted the economic strength in the United States. There were a lot of people who were bearish. We kind of took the road less traveled. What I talked about back then was we said, listen, the truth is the economy is not perfect, but the consumer makes up almost 70% of the economy, and the consumer was still really strong. At the end of the day, the United States economy, nominal basis, grew 5.8% last year. That was more than China, okay? So, like, nobody expected that. Even we didn't think growth would be that strong. But it happened. And then as we fast forward into 2024, into an election year, we're still overweight equities. We've been overweight stocks since December of 22. We still think stocks are going to do well. I mean, the time you and I are recording this, S&P's up like 8% for the year, which is pretty solid year. It's only April, or March. Not even April yet. I don't even know what month it is. It's still March, which is really good start. But we think there's still upside. Now, put a bow on this on the economy. The consumer might take a little bit of a step back this year. The U.S. consumer, as again, higher rates and some of the things, the economic cycle is aging, but that's not a recession. And what we're optimistic about, we look at things like manufacturing and housing, even government spending. Those should all pick up a little bit in 2024. So it's kind of passing the baton around. The consumer is still healthy. We can get into that. But overall, we do not see a recession in 2024. We've been saying stocks will go a good deal higher, and you're off to a great start. We think there's more upside to come.
What are your estimates for the U.S. interest rates? Will there be a few cuts, maybe 2 or 3 or more? What are your analysis in that sense?
Yeah, so 2 months ago, it was baked in for the Fed to cut maybe 5 or even 6 times. We pushed back on that. We said it'd probably be more like 3 or 4. We're still in that camp of 3 or 4. And you think about what's happened the last 6 weeks specifically, or really, I guess since the end of January. End of January is when the Fed kind of pushed back. They had a Fed meeting, and they pushed back on rate cuts. But then the funny thing happened. S&P gained over 5% in February. Stocks did really well, yet interest rate cut expectations were lowered and even pushed back. So it's because of the economy, right? Because the economy's strong and earnings have been strong. But to answer your question, we think it's fine that a couple cuts now aren't going to happen because the economy's strong. In 2022, when we had the terrible war, the supply chain issues, massive inflation, an economy that was teetering on a recession here in the U.S. and globally for that matter, the Fed was hawkish to slow down inflation. The Fed's a little more hawkish now because the economy is in good shape. We don't think that's a bad thing. So we think 3 or 4 cuts, probably starting in June, will be perfectly normal. But the bottom line is the Fed is not hiking anymore. They're done hiking. We don't think any hikes are coming anytime on this current cycle. And again, that's I hate to say the Fed stuck the landing. So many people doubted the Fed could do it. But they did a pretty good job threading that needle, and overall, inflation's clearly come back, and the overall economy avoided the recession in the U.S. So we're optimistic that 3 or 4 cuts this year, and things are still looking pretty good.
In fact, I want to ask you about inflation, and if you think there is a chance of a rebound this year in inflation. We see last numbers are picking up if we take in count the last numbers in 2023. So do you think this sticky inflation could create some risks to picking up and to be more sticky in 2024?
Yeah, I mean, we don't think so, but here's a little more on that front. So, CPI, the consumer prices in the U.S. are over 9% year over year the summer of 22. Recently came in around 3.2%, a little bit hotter than expected, a little bit higher than expected, and the producer level also. Then you just look at things like commodity prices, gold, yields here in the U.S. have all moved up a little bit. So the worry is we've got this sticky inflation, like you said there. But I mean, we'd say no. Here in the United States, so much of our inflation comes from shelter. Shelter is like your house, right? Rents and things like that. If you take out shelter, 6-month CPI recently is running up 1.8%. Over the past year, it's running sub 2% as well. 2% is that Fed kind of target. So, and I know it's like, okay, you take away this big component, but a lot of people in the United States own houses. They've got mortgages locked in at 3.5%. So we're a little skeptical. Plus, the private data, things like apartment list and Zillow here in the U.S., private data shows rent prices have been negative year over year for 8 or 9 months now. The government's data is still saying around 5 or 6%. So there's this disconnect. But again, we'll put a final comment here. We looked at the CPI data again that came out last week that was hotter than expected is what they told us. When you looked at it, like restaurants, right? Like what do you charge to go out to eat, right? That's come drastically down. Even groceries, which are up like 14% year over year at the peak, are only up 1% year over year. And those are some of the things clearly that consumers care about. You think restaurants, I mean, what are they doing? They're paying for wages. There's commodity prices in there. There's rents that are in there. There are some major positive signs under the surface, in our opinion, on the inflation front that, again, to us, we don't think. I mean, we just had this big surge. We dropped. Now it's popping back a little. We're not super worried that a major comeback in inflation's coming. And the final comment, really why, we've had a major jump in productivity in the United States the last 3 quarters, 3.7%. We haven't seen anything like that since without a recession. Productivity usually goes up in a recession, but without a recession since the mid to late 90s. When you have higher productivity, and we think we're entering this is one of our big themes of our 2024 outlook, to have stronger productivity going forward here for the next several years. Higher productivity allows you to pay higher wages, but it puts a cap on overall inflation. One of the big problems in the 1970s, we had massive inflation. You also had massive wages, right? And productivity was low. Well, in the mid-90s, we had about 4 to 5% wages. Productivity's running about 3%. Overall inflation's 2 to 3%. That sounds a lot like right now. So we think with strong productivity, it's going to be really tough, in our opinion, for inflation to come soaring back. And that's a real positive thing for investors and likely the economy.
You said one thing that I think is very important. That we have the highest level in productivity since 2008. I see the last report to Bank of America that said we are in this level, so I think it's pretty nice to have a good inflation for the future. But I want to ask you one thing is related with the energy sector. Energy sector are rebounding. Do you think this oil prices rebounding right now and gasoline prices in the United States are temporary, or are some kind of concerns in this area, in your opinion?
Well, great question. I mean, oil prices have come back. Energy stocks in general have been all of a sudden fairly strong. We're more neutral energy stocks. We think industrials, financials, some of the other cyclicals will do a little bit better. But to answer your question on energy, I mean, the truth is, again, if the economy stays strong, the U.S. economy stays strong, global economy stays strong like we think it can, there's a lot of demand there. So we wouldn't be surprised at all if energy prices continue to move higher a little bit here going forward into the summer driving months and things like that. But that's not the end of the world. I mean, energy peaked at $145 a barrel back in, I think it was 2008, summer of 2008 here in the U.S. So listen, we're a long way from that. Yes, I mean, people don't like to go to the pump. They don't like that to pay more when they go to the pump. And that is very true. At the same time, we say, listen, look at net wealth, right? Net wealth has hit an all-time highs here in the United States, and honestly, globally, housing's gone up a lot. Stocks have obviously gone up a lot. People have made a lot more money. So everybody wants it both ways, low prices, but to be very wealthy. It doesn't always work that way. I mean, so, you know, we all want this perfect scenario, but the bottom line is a little bit higher energy prices we think is not abnormal. We don't think it's going to go soaring higher. And overall, inflation will still be fairly contained. Again, as you know, you can have higher energy prices. Again, if it's demand function, we don't get supply at all. And one final comment, the United States is pumping over 13 million barrels of oil a day right now, right? That is double what we were doing just a couple years ago. And in the 1970s, or in the oil embargo of the 70s, when oil spiked, and the recession of 73, 74, the U.S. didn't like pump any oil back then, right? So again, you hate to say this time is different. The four most dangerous words, Sir John Templeton. This time is different. The U.S. has been pumping a lot of oil, and we can still kind of continue to do that. But overall, a little bit higher energy prices doesn't concern us that much.
I want to ask you about another topic that you mentioned before, which is the U.S. elections, and how could U.S. elections affect economic growth and stock markets, in your opinion? I mentioned that because you publish some threads in your Twitter account related with the performance in S&P 500 with the U.S. elections. So how is your point in this sense?
Sure. Well, the U.S. elections are obviously a very big deal over here. People get very heightened and very, very sensitive to the elections, and they worry about, oh my goodness, if this person wins or if that person wins, it's got to be bad, right? You just hate the other party, so it's got to be bad. We would say, listen, separate your political beliefs from your investing in the fundamentals. The truth is our economy is really strong right now, and I'm not so sure if it matters who's in the White House when you have a strong economy. In fact, we'd say it does not. I mean, during President Obama, a lot of people didn't like him. Stock market did very well. People didn't like President Trump. Stock market did very well. People don't like President Biden right now. We're like at all-time highs practically as we sit here and talk on the S&P. So again, it's important to separate it, but here's the bottom line. If you look at election years with a first-term president up for re-election, like we have right now, the last 10 times, going back to Eisenhower in the early 50s here in the U.S., the S&P 500 has been higher 10 of the last 10 times, up over 12% on average when you're in an election year with the president up for election. Where trouble has come before is a lame duck president, meaning president who's not going to be up for re-election. 2000, 2008, 1960 were some of those years when things didn't go so well. Now, it's never as simple as you know, who's in the White House. Again, what matters more is the economy. I'll be very, very clear. But for investors who just say, I don't trust the stock market in an election year, I'm going to wait for the election, I'm going to wait for things that show clarity, we would say that could be a very, very big mistake. And again, with a strong economy, makes up for a lot of sins, especially on the election front.
Another focus is on Wall Street is on market breadth. I asked you the last time that I interviewed you, but last time or since last time, the scenario has changed. And I want to ask you because the heavyweight of the no longer 7, but the magnificent 4 right now, is this healthy for the stock market, or should it improve in your opinion?
Well, yeah, the argument this time a year ago, right? Not even maybe when you and I spoke, but just a year ago in general, all we ever heard was, oh my goodness, it's only 7 stocks going up. It's only 7 stocks going up. We pushed back on that repeatedly, saying, listen, that's not true. There are a lot of other stocks going up. Those big stocks, yes, their market caps are so wide and so large, they accounted for a lot of the gains. I think it was just a thing the media like to do to get people worked up. And if you actually counted the numbers like we did, we said, listen, this is bullish because there's a lot of stocks going higher. It's not just 7 stocks going up. Fortunately, We saw what happened. S&P gains 25%. It was a really strong year with a lot of gains, not just 7 stocks. You go to right now, though, one of our big themes of 2024 was a rotation, not necessarily out of the big cap tech names that have done so well, but maybe a little bit, and into small caps, into mid caps. There's some really good values there. I mentioned energy. Well, you mentioned energy. Energy is like what, 3 or 4% of the S&P 500. Materials are like 2 or 3% of the S&P 500. Very small parts of the S&P 500. What I'm trying to say. We're seeing rotation into these areas. If you'd have told me 2 months ago that NVIDIA'd be down, not NVIDIA, wrong one, Tesla, that Tesla would be down like 30% for the year, Apple be down significantly, Amazon be struggling a little bit, Google be struggling a little bit. Oh, by the way, you push back interest rate cuts, like we did, I would have probably assumed, like a lot of people, the market would probably be down, maybe by a decent amount. That's not what happened, though. So again, it's showing the lifeblood of a bull market is rotation from one group to the other. We are more even weight technology. We've got a slight overweight to communication services, but again, we think these other cyclical areas, as this baton gets passed around, as this economic cycle ages, as this bull market ages, it's not just going to be about all tech and communications, and it's really impressive to us to see some weakness in some of those names that everybody promised us a bear market if those names struggled. That's not happening. The money is sloshing around, going to other areas. That's a healthy sign in our opinion.
And I want to ask you just the last one, which is, what would be your target or your price, no, your target, yes, for S&P 500 this year, given the amounts of gains so far? So do you think we have another strong second half of the year, this 2024?
Well, we do. I mean, we've been overweight equity this whole time. Yes, our target at the start of the year is about 5,400 on the S&P 500, which was much higher than a lot of other places. That's low double digits, 12, 13% return. I mean, we're not all that far from there either. Maybe we up that target, but the money and the models that we run for our Carlson partners, we remain overweight equities. But we've honestly thought there's more opportunity in small and mid caps. Mid caps are probably our largest overweight bet that we're making. Mid caps quietly are doing well. I wouldn't be surprised at all if we looked up at the end of the year, mid caps and small caps might have gained almost 20%, right? I mean, more than the large cap names. So that's just kind of how we look at it. But again, just because we're getting close-ish to our target, we had a much larger target. I mean, this time a year ago, we said the S&P could hit all-time highs. People thought we were crazy when we were saying that, and then obviously stocks eventually did hit all-time highs, and we're still a little more optimistic than probably most people. But let's be very clear: the last which one do I want to go with here? Here's final example of this. We just had the 50th trading day of the year for the S&P 500 in the U.S. last week. S&P was up over 8% as of day 50. There's about 250 days trading days per year, so there's another 200 days to go, give or take. When you're up at least 5% on the 50th trading day, like we were, I found 25 times. The rest of the year has been higher 24 out of 25 times, with some extremely strong returns the rest of the year. That's just one data point. I get it. But 24 out of 25, when you have a strong start to the year, we think a strong start to the year likely means when we look up and all is said and done, stocks will be a good deal higher than they are now. That doesn't mean it's going to be easy. We're going to have pullbacks. We might have a 10% correction, right? We have a 10% correction on average once a year. As good as last year was, we had an 8% correction in March when the regional bank crisis happened. Then your standard fall sell-off in August, September into late October, 10% correction, and then the market just soared up 13, 14% the last 2 months. We think, again, it's going to be rocky, but we look up when this election's over and the year is over, low double-digit returns, maybe a little bit higher on S&P, but being led by small and mid caps is how we still see things playing out.
So, as I said in the introduction of this interview, thank you very much again to be with me here in my channel, Ryan Detrick. It has been a pleasure, and you are welcome here whenever you want. So, thank you very much.
No, I appreciate the opportunity. Glad we could find time to make it happen, and look forward to hearing what the listeners have to say. Thank you for having me again. Take care.
Thank you.